Hey everybody, I'm Justin Bogar with Bright Path Notes, and this is Wednesday, November 10th, 2021. This is the Real Estate Note Investing Be the Bank broadcast. We're going to be talking about Note Expo that happened last weekend, and Richard and I will be discussing that a little bit today. Got some case studies for you and some kind of updates as what's going on in the mortgage industry right now. So stay tuned, and we'll be at you in just a second. Well, hey there, Richard.
Morning. No, it's afternoon, Justin. My gosh, time's gone by fast.
What are you in Hawaiian time today?
I tell you. Hey, I want to know where that big vault is on your opening slides. Is that in your backyard someplace? You have it in the garage? Or?
I can't disclose that information, nor can I confirm or deny that it actually exists.
Okay, I got it.
All right, man. So today is November 10th. Today is my dad's 70th birthday, Richard.
I like it.
Yeah. The old man, he worked at Eli Lilly for 45 years. Started right out of college, mopping floors, and he had a major he majored in chemistry. And so pharmaceutical company is a great, place to get into in the 70s there. And so started mopping floors and made his way to the lab, and then went up the corporate ladder and stuff, and ended in dealing with the FDA and getting drugs approved all across the country. So it's kind of exciting to hear some stories about how the pharmaceutical world works.
Yeah, those days of working 45 years in one place are gone, unfortunately.
Yeah, it's pretty loyal. Yeah. So some of the guys that started around him, and other businesses and friends of his, it's just like, wow, yeah, you don't hear that anymore. You hear somebody that has had a job for 6 or 7 years. That seems like it's pretty long. Yeah. So anyways, and he played in a band, kind of like a side gig. He would do covers of like Beatles and Elvis and just classic rock and roll type stuff.
What instrument?
So he could play piano, keyboards. He could sing lead vocals. He could play lead guitar and rhythm guitar. And he knows how to play a little bit of bass. He can do everything but drums, I think. So.
How about you? Can you do any of that?
I cannot do any of that. I have no musical talent whatsoever. I do karaoke. I want to by myself, so no one can throw anything at me or make fun of me. And perhaps occasionally singing in the shower. But yeah.
We won't ask about that. We'll just let that
we're not here to talk about that.
No.
So what's new with you, Richard?
It's a clean show.
Right. Family show.
That's right.
So what's new with you, Richard?
I'm starting to see a little more note activity. That's good. I think the Note Expo was a really good event, and I know we're going to talk about that a little bit. Mm-hmm. I think some people are anticipating non-performing notes and what's going to happen there. Note School's got some interesting stuff with their Easy Finder program, so it's exciting time.
Okay. Yes, both of us were at Note Expo. It's I consider it the largest note conference for note investors in our community for the whole year, right? So it's always the first weekend of November, and it's held typically in Dallas, Texas. And Note School and Colonial Funding Group are the organizations that kind of steamroll this and put it together. And it's a big event. I believe, Richard, they had over 450 investors and vendors there at the conference for the 2-day conference.
I think that's right. Yeah.
Yeah. Mm-hmm. So it's a pretty big one. I think it's the second biggest one they've had. I believe they've been doing it for about 10 years, maybe.
Yes, that's right. And considering we're coming out of COVID, I thought it was pretty amazing that they had that many people.
Yeah, it was great to see a lot of people, hear a lot of stories, great speakers and stuff. And we're going to, throughout the broadcast tonight, we're going to drop little things that we heard throughout the conference. So, Richard, quickly, what was your biggest takeaway from the Note Expo conference?
I actually think my biggest takeaway was how many people are trying different creative things with notes. In other words, they're dropping mail, they're making phone calls, they're creating their own notes. They're buying properties to do just a little bit of renovation on, maybe just a little bit of dust up renovation, and then creating notes out of that. I mean, there's a lot of that activity going on.
Yeah, I was interested in hearing a lot of the bigger companies or hedge funds on what's kind of coming down the pipeline in the next quarter or two as far as like non-performing loans is concerned. And I don't have a bunch of data and figures in front of me about that, but what was interesting is that we're going to get into kind of COVID forbearance numbers a little bit later in the broadcast. But what stuck out to me, Richard, was there was a mention of a lot of non-performing loans that were non-performing before COVID even happened, delinquent as far as 2015, 2016. And a lot of these banks didn't take them through foreclosure. And then all of a sudden COVID started to happen and they really couldn't do anything. So they got another 18 months of riding the wave there and not performing. So there are some 5, 6, 7-year delinquent notes coming through the pipeline here that are trading at the Fannie Mae and Freddie Mac level currently. And so it'll make its way down to us here pretty soon. I wouldn't guarantee it by the next quarter or two, but we could be seeing some action here to be able to get some non-performing. Now, the volume of it, I don't know if it's a 500,000, $1 million, $1.5 million loans coming through. I don't have all those figures in front of me, but there will be some opportunities coming up pretty soon. And I would guess, Richard, probably by the springtime of next year, we'll probably be seeing some non-performing coming through our way, and maybe even sooner if we're able to.
Yeah, I think so. And I think maybe we should have a session for the crowd here on that in terms of how you do that. I mean, I know that I'm going to start circling the wagons a little bit myself, and I've resisted getting into non-performing notes because they're a little bit labor intensive. But if you do it correctly in parens and designate an area, get set up with, say, a local contractor, that type of thing, so that you don't get fleeced, because that's always the problem, is that your costs get out of hand on these. I think you can make a tidy sum on a lot of these.
Yeah, I agree. Richard, let's get into our broadcast. All right, my friend. So we got to start with our disclaimer here, Richard. Neither one of us are attorneys. We're not tax consultants, and we're not financial advisors. Anything that we talk about are just from our experiences and our knowledge in the business. So please get your competent legal counsel or legal tax competent advice. The broadcast would not be possible without some sponsorship. So let's shout out to Bright Path Notes, our company here. We got the note deals. You can reach out to me, Justin, brightpathnotes.com, if you're looking for note deals. And we got a website. If you go to our website, brightpathnotes.com, and I believe it's /note-deals. Richard will pop this up on the screen in just a second, and you can see any sort of deals that we have had in the past. We will be updating it with some new deals here pretty soon. Our local RIA organization, CI RIA, Central Indiana Real Estate Investors Association, is a club here, and they are a sponsor for our broadcast as well. You can reach out to the new executive director there through email or phone number listed below. They're a great educational organization that talks about not just about notes, but about everything in real estate. And if you're looking to get boots on the ground locally here in Indianapolis or Indiana surrounding county areas, that's who you want to get involved with. So lots of real estate investors involved. I think we have over 800 or 900 members now, Richard, that are part of the Central Indiana Real Estate Investor Association. We have a training course, if you guys didn't know. It's called Constant Cash Flow. And if you'd like more information about this training course, it's basically a fundamental video class that kind of gets you terminology and understanding what all these things mean about notes. So if you've never bought a loan before, if you bought a couple of loans before, or if you've bought 4 or 5 loans before, it's a great refresher to get you kind of up to speed on the note investing fundamentals and give you strength and knowledge to move more advanced topics, because you kind of want to branch off where you think you want to go from there. There's a lot of things to do in notes that are fun. Anyways, you can email info@brightpathnotes.com so you can get more information about it. And then we also have a website for it. If you go to brightpathnotes.com and you look for constant cash flow, you can find a link to sign up for the training course. Our final sponsor is a self-directed IRA company called New View Trust Company. They're out of Florida. And if you mention this broadcast, they're going to waive the setup fee for you when you fill out an application. They can do all sorts of self-directed IRAs. They can do IRAs, Roth, traditional, 401ks, solo 401ks. They can do Coverdale educational savings account, health savings accounts. You name it, they pretty much do it all. So we've had them on the broadcast before, I believe earlier in 2021. And so you can look that broadcast up and you can watch what they went through on that. Central Indiana real estate investors, this slide is for you. And there is a QR code here. If you get your smartphone out and you get your camera and you just look at the QR code through your camera lens, you don't take a picture, it'll actually bring up a website and you can click on it and get your PHP credits. That is for you. If you don't want to do that, type in http://bit.ly/Cyria notes. Fill in your first name, last name, and email address, and you will get your credits. All right, Richard, the podcast that I have with my friend Super E is called The Two Wealth Show. And it's on all the podcast directories. We record it on YouTube as well. So we post it to this YouTube channel, Bright Path Notes, and you can find the Two Wealth Show, and we can do a lot of interviews and stuff with it. So it's about building wealth and showing other people that have built their wealth and through real estate. And so we got some pretty cool interviews we've done so far. We got some cool interviews lined up towards the end of this season. All right, Richard, today's agenda for November 10th, we're going to be talking about the note basics like we always do. That's where we kind of show our audience here that's never been in notes before, just kind of new to it, just to get a quick understanding of what the heck we're talking about and what we're investing in. We're going to go over the mortgage industry update with the Black Knight financial data. And I got a couple of case studies for us, Richard, to kind of review and look over.
Sounds good.
All right, let's get into the note basics here, Richard. So we got a buyer and a seller in a house. They both agree on a purchase price. And so they go to a title company and close, and the seller is on the deed currently. And so they convey the title over to the new buyer, and that buyer is probably going to put a small down payment, and then they're going to get the rest of their funding from a bank. That bank is going to write a promissory note and mortgage, and that mortgage is going to secure that loan that they give the borrower against the property. So that way, if something happens, they have the real estate to go back and get their money back. Mm-hmm. So after the deed is conveyed over to the borrower, they are now the deeded owner, and the bank owns the note. They do not own the house. So now we fast forward to how investors get involved in this and what this circle looks like. So we have this investor over here in the corner. They got a set of cash. This could be an LLP, an LLC, a retirement account, you name it, just something, an entity with a lump sum of money, and they can just buy that note just like that. So instead of the homeowner paying the bank, guess what? The money now goes to the investor. Nothing changes for the borrower. Instead of paying the bank, they're paying the new investor, the new lender. In their eyes, it's the new lender. Mm-hmm. All right, let's get into the mortgage industry update, Richard. So we go over this monthly, and we've been seriously keeping track of this ever since COVID kind of came into fruition. And we've noticed a trend in a very positive direction for us as investors. And so September is no different. And we're going to go over that. And I got a couple of slides dedicated to it. So Richard, I know we talked about this a little bit before we got on live on the broadcast here. So the delinquency rate has obviously gone down, which is a good thing. What you kind of dumbfounded us a little bit when we looked at this data, Richard, is for the rest of the audience, that the foreclosure starts kind of went down and active foreclosures kind of went down too. And Richard, correct me if I'm wrong, but this may have to do with the fact that September was a big turning point in the forbearance timeline because a lot of loans expired at their 18-month expiration date in September. So I'm wondering if that's why a lot of those loans, became reperforming instead of going into active foreclosure. And that may be the reason why these numbers appear to be in a negative light. But I think it's because a lot of these forbearances actually became reperforming.
I think I agree with that, but I also think that the refi market is still roaring, and a lot of people are just refining out. I know that I've had two of my notes paid off, and they refied and got conventional loans. So good for them.
Absolutely. So yeah, there's just some good reasons for it. All right, the national delinquency rate has now dropped below 4%, which is the lowest it's been since before the pandemic. So that is a good sign.
That's amazing to me, given what we've gone through. That's totally counter to what I thought would have happened.
Yeah, I agree. It's resiliency, I think, is a great word to put into perspective as it pertains to real estate. Resiliency with market value, resiliency with delinquency rate, with what we went through. I mean, this chart shows a very abrupt spike and then a very abrupt downturn with it as well in a positive way. So this is another great reason why real estate is a great security for your investment.
Right. And so you have to also wonder, I mean, I know that in a lot of what we do, we're talking about the middle price band or lower middle price band. But a lot of folks out there in this index have done very well in the stock market. And I wonder to what degree, since the stock market is roaring, they're using some of their profits. They're taking some of their profits to offset their mortgage costs and thus staving off delinquency.
That's very true. So again, real estate resiliency, I think, has been solving a lot of these potential problems that could have been a lot worse. And we're going to look into some more data here in a second to show you what we're talking about, the comparisons between the 2011 timeline and to the 2021. So a decade of difference we're going to go over. So Richard, again, all this information that we're getting is from Black Knight Financial Data. You can go to their website, you can download the reports and look at the same things that we do. It's probably a 20-page report, and we just kind of pull out just some bits and pieces that look interesting or entertaining, or just to show a story as to what's going on with forbearances. And we always try to put things into perspective with data. If you have any comments or any questions about notes or about any specific subject matter that we're talking about today, please use the comments. Go to your comment box. If you're on YouTube, you go in there and just type in your comment, and then we will either answer it live during the broadcast. We'll wait till our kind of after party where we have more of a Q&A, and then we'll answer your question then. So please don't be afraid to pull up that comment box. If you want to say hi, let us know where you're at. Let us know how you're doing today. If you went to Know at Expo and you want to say something, please do. We encourage all sorts of feedbacks in the comment section of YouTube. All right, Richard. So loans in forbearance, you can see the total is about 1.239. Let's just call it 1,239,000.
Why don't you just call it that?
Yeah. And that is what's currently in forbearance for COVID. So breaking this down into three kind of sectors here, we're going to say Fannie Mae and Freddie Mac have about 373,000 of those in forbearance. FHA and VA loans make up about 475, and then the portfolios and stuff and civil securities are about 392,000. That makes up that 1.2 million number of forbearance today. Right. We started at 7.7, and now we're down to 1.2. So you can look at the unpaid balances now in the second row of loans in forbearance. This is in the billions, okay? Fannie and Freddie is 76 billion. FHA and VA are 80 billion. And the portfolios and stuff are 75. So they're all pretty similar in unpaid balance, but you see how the numbers are drastically different. So one would surmise from this that Fannie and Freddie and the portfolio loans are probably higher valued homes and higher valued mortgages, and the VA and the FHA are probably lower valued ones. And it makes sense, right, Richard? Because if a first-time home buyer or someone that has difficulty qualifying for a conventional loan, they're probably going to go the FHA and the VA route, which would mean it's probably a little bit lower valued home as compared to the other lenders, right?
Right. And they've also probably got a lot less down, a A lot of the VA loans, you have 0% down, or FHA, you have 3% down. So,
So that's kind of what that is. The last row there is the monthly P&I advances on active forbearance plans. So that's where the lender, or more likely the servicer, is already taking care of paying for those payments that are not being paid. So it's almost like an insurance policy, right? So there's a $500 million in Fannie, Freddie, FHA, and VA, and then about almost $1 billion in the portfolio sector. So it's just interesting to look at this data and see where it's coming from. So if those loans all needed to go through foreclosure, that's the billions of dollars in UPB that would be coming down the pipeline in the future, which would be about $231 billion. I'm not saying that's going to happen. I'm just saying if this was worst case scenario, it's more than likely going to be a small fraction of this that'll come down the pipeline.
you could buy half of that yourself, couldn't you?
I could. I could take it all down, just me. I would probably get a partner just to lower my risk, though.
Okay. All right.
All right, Richard, 7.7 million forbearances. Let's kind of carve this up with the pie here. So green is good and gray is good. Green and gray combined to about 74% of the forbearances. So that means out of all the forbearances that happened during COVID, 74% of them either became reperforming or they paid off early because of the tappable equity or the appreciation in their home. They're able to get refinancing, or they just sold the house.
Right. That goes back to my earlier point about the rates being low and people being able to refi.
Unbelievable. I wouldn't have imagined 18 months ago it would look like this. I would thought it would be less than that, just based off of past history that we've been exposed to. So this is a really positive sign. So this is what we like to see. That's why we like to show the charts.
Mm-hmm.
You have any other comments about this?
Well, I was just going to say, I think that it's certainly positive and reflective of the market. What's going to be even more interesting is when you get into your next chart and you show the 10-year difference. That's pretty remarkable.
Let's just get into that. Good segue into it. So this is a chart that I typically don't show from the Black Knight Financial Data. It's towards the end of their report, but I noticed this when I looked through it quickly, and I thought this was a pretty interesting stats, and I just want to explain this. So if you look at the bottom row here, this shows where they stopped collecting data before they generated this report. So obviously it comes monthly. So you notice that September 30th of 2021, that's when they have this data collected. So the first column there shows the total active loans that they're aggregating here. So it's about 53 million. Of that set, you see the next column is 30 days delinquent, and 60 days delinquent, the 90 plus FC is foreclosure, and then the last column there is total non-current. So that means everything in total, which will be all those numbers kind of added up there. So the foreclosure starts, you see what that is, the average days delinquent for 90 plus, the average days delinquent for foreclosure, and the ratio of 90 plus days to foreclosure. So this is what's really interesting. So if you look at the top row, you notice that it's January 31st, 2011 is the first data point they have on this chart, the first row. So if you look at the total loan count, it's within 1 million. You look at the next column, you notice, wow, there's 1.75 million loans 30 days delinquent. And you look at today's numbers, and it's 638,000.
So that's only half.
Big difference there.
It's a big difference.
The 60-day marker is a little bit more of a difference, right? It's about 3x there. It's 750,000 loans and 60-day delinquent versus almost 200,000.
Right.
The 90-day marker is interesting too. It shows 90 plus days. That means if they're delinquent past 3 months, then they hit this category. So it's over 2 million loans. And then today it's 1.23 million loans.
Right.
Foreclosure starts as a very different world. So if we were in 2011, we'd see about 2.2 million foreclosures active right now. And so we see 135,000, we'll call it, loans in foreclosure. The non-current's interesting as well. 6.8 million non-current loans versus 2.2 million non-current loans with this data. Foreclosure starts again. You got 275,000 foreclosure starts. This should be per month, by the way.
Right.
And about 4,000 loan foreclosure starts currently in today's market. Now we're going to get into some. So you see the trends are there was a crap ton more loans in a bad situation in 2011 and a big cluster of them, right? And then now it's a lot smaller, a lot more manageable. Now we're gonna talk about
Why?
some differences of what's going on here. So we see the average days delinquent for 90 plus days delinquent loans. So it's 400 right now is the average delinquent days, and 2011 is 333. The average days delinquent for foreclosure, we see 527 for 2011, and we see 1,700.
So can we talk about that just a little bit?
Let's slow down and talk about that.
So let's talk about that. So in January of 11, we had interest rates that were in the 8 to 9% category. People couldn't refi. Basically, there was no place to go. So they were going to be in delinquency a lot for a lot slower time because they just went, there was nowhere to go. They might as well just go foreclose, jump out, have a short sale and get out.
Yeah.
Come around to what we have now is we have a much longer delinquency period because number one, we got COVID and we have you can't foreclose during that whole time. And we've got a lot lower interest rates. So people can borrow, they can do other things that they couldn't do before to stay off their foreclosure. That's my take on this.
Yeah, it's interesting. I agree with what you're saying. If you look at the ratio of 90 plus days delinquent versus foreclosure, it's a 913% difference. And it was about 93% difference. The ratio is 93% of in 2011. So that's what you're saying is correct. So loans got caught before COVID, and COVID just made them even more delinquent. And that's why you're seeing the average days up there pretty high.
Right. So this is a great chart. The numbers are probably a little bit small for the audience, but I think we could sort of summarize everything we've just said here by the fact that an NPL wave is coming, NPL being non-performing loans. Mm-hmm. It's not quite as robust as everybody expected it because of a number of offsetting reasons. It may be a little bit later than we thought. Rather than a tsunami, it's a pretty good sized wave, and that's still okay.
And I think it'll come in sets too, like waves come in sets of 3 typically. Mm-hmm. So I think it'll instead of being one tsunami, like you said, it may come in smaller sets of waves, but it'll be more consistent. So maybe every couple of months there'll be maybe 50,000 foreclosures coming through. Let's just throw out a number there. Let's just, I think it'll be more manageable this way. So the numbers will go up. It's just, I don't think it'll be like just a big Christmas package, delivered, dropped off. It'll be a bunch of small presents here and there. So I think it'll just be more manageable. It'll take a longer time to get through all this. I think it may take, over a couple of years as opposed to just getting through it within, 8 to 12 months.
I agree. And you have a vast knowledge of waves coming in sets of 3 because of all the surfing that you do there at Indiana. Is that it?
In Indiana, that's right. All these oceans that I have connections with.
Opposed to what we do out here in California, just kind of,
Yeah, you just roll out of your house there, Richard, on your surfboard, and you're right on the beach, right?
Surfs up, dude. That's right.
Surfs up, dude. Right on. All right, Richard, that was the mortgage update there. So I have a couple of case studies, and I didn't get to explain all of them to you, Richard. So some of this information will probably be new to you, but I wanted to kind of be real about what can happen with notes. And so I had bought a performing loan, Richard, probably, I don't know, maybe 2 years ago, a year and a half, 2 years ago. And it was a great performing loan. I had a few issues with it as far as it got behind by a couple of months and got back up. And then I had found out that the original borrower had passed away, and the daughter of the borrower, she obviously survived, and she was actually on the mortgage itself. So she just kept paying the mortgage.
Mm-hmm.
And so she paid the mortgage for another probably year or so, maybe a year and a few months. And she was on like an ACH type of payment, and everything was working really good. So I had this loan in my inventory to sell to one of our investors. And so I actually sold this loan. That's in Inkster, Michigan. And I sold it in August of this year. And so the first payment that was supposed to be due to the investor I sold it to was like August 15th, let's call it. So August 15th came and the borrower didn't make a payment. September 15th came, borrower didn't make a payment. October 15th came, the borrower didn't make a payment. So the investor is making me aware of this at this point, and he's like, I don't understand what's going on. So I kind of still have a connection with the servicer that's servicing this loan. I kind of dive into it a little bit and come to find out that the borrower is not able to make the payments anymore because of financial struggles. And they don't know what to do. They got behind a little bit on not making escrow. So the taxes are coming up due, and so they need to be paid. And so I was explaining to the investor that, you kind of got some options here. When you're the bank, you have this piece of collateral that is your security. And so you have a right to take back that piece of property so you can, recoup your investment back, right? And maybe then some. Mm-hmm. So I gave the options to the seller, told them what they could do, told them I'm here to help you, whatever you need to support this. It just kind of stinks. They bought this loan. They never got cash flow from it because they wanted to be the bank. And so they said, well, I don't really want to deal with all that stuff. And I said, I tell you what, I said, if you want, I'll just buy this loan back from you. And then I'll go ahead and make up those lost payments that, that you weren't receiving. So it's as if you just receiving the cash flow from the get-go. And I can put you in a different loan that's cash flowing and that I don't see a problem with either. And you're going to be getting about the same payment, same return, same term and everything. So it kind of worked out that way. And they were ecstatic. And I said, I also explained to them that this house that is not making payments on is worth more than what you have into it. And we kind of guesstimated it was worth, maybe 15 to 20,000 more than it is. But they still decided they just wanted to be the bank and the cash flow, and they don't want to deal with, the property and stuff like that. And I said, okay. So I had no problems, buying this back in the situation that I was in, and knowing that the borrower was ready to basically just sign over the deed and just, be done with it. So again, we gave options to the investor, make sure they knew what was going on, and then we just repurchased it plus those missing payments.
Great.
So how this worked was I actually repurchased this, and I ended up costing me about $28,000 with, corporate advances, buying the loan and making a couple of payments to the investor as well. Just lumped it all together, made it nice for them. They're in another loan now. They're happy. They've funded the deal, and they're cash flowing with a different investment. So I can handle this. I can absorb the process of a non-payer. As its value is probably around 45, 55. I'm being conservative. It's been shown on a couple of websites. It may be worth 60 or 70K. So we'll see. But I'm going to assume it's in the condition that it's in with the pictures that you see in front of you. It looks like it's pretty well maintained outside. I'm sure the inside's just been empty for a while. So property preservation is the next priority, Richard.
That's right.
If this is in Michigan, it's going to get cold pretty soon. So we need to winterize the property, need to get in there, need to secure it, make sure everything's okay, make sure whatever needs to happen to it with the property preservation process. So it is in Michigan, which is a pretty fast foreclosure state. They can get things done within 60, 90, 120 days. It's not uncommon for them to speed through stuff. So that's all a positive sign. And I possibly have the ability to make about 15 to 20K on this delinquent loan.
Sounds like a good deal.
Yeah. So this is probably not going to be an uncommon story in the future here, where some performing loans end up going sideways. The great thing about having the environment that we're in today is that home values are appreciating so much and so quickly that even if you bought loans at a very small discount, you may not be in a bad situation, because that
Right.
appreciation may end up actually making you a little bit more money than you think. So this is assuming I could get through this in 120 days, getting a 15K profit on 30K of money. It's a pretty good ROI.
Right.
So we got that going for us. So Richard, one of the things that I know you and I talk about a lot, and we do together, and for our listener here, is we buy a lot of loans from what we call mom and pop sellers. These are folks that create seller finance paper. They probably don't know how to sell the property, or the property wasn't sellable, or the borrower couldn't get a bank loan. And so they decide to sell their property with seller financing. And Richard and I know how to market to these people through, sending mailers, cold calling, different ways through technology that we can reach them. And then we get them on the phone and we can kind of talk to them. And so, Richard, I thought I would share with the listener here some things that go on with this. So first thing I want to talk about is common issues we find with the seller finance paper. You can imagine, Richard, right, that these notes are probably not written as if a professional was writing the notes, right? So they're probably going to skip a few steps. There's probably going to be some language that's kind of weak, and it's not going to be a traditional Fannie Mae or Freddie Mac type of mortgage.
Right.
We're pretty much 9 times out of 10 seeing a land contract. And land contracts are a very secure instrument, and they're fine, but they can be very poorly written. And we see a lot of language in there that's contradicting. Things don't align and make sense. They try to mention taxes and insurance, and they lump it into the full payment. And then things just don't jive as far as, we've even seen some that don't even have late fees built into them.
Don't have late fees, and I think we saw one recently where they gave us the loan amount and the payment, but not the term. And we said, "Well, how long are the loans for?" And he said, "Well, just he's paying me $500 a month. It's whenever it's paid off."
Yeah.
Okay.
Yeah. So there are some issues when you buy this. So buyer beware, right? But Richard and I have done plenty of these deals, so we're very comfortable, and we understand what happens. So the other problem is, Richard, like you mentioned about payments, they're self-servicing the payments. So who knows how accurate this is? I mean, if the borrower is paying 10 days late one month and paying on time the next month, there's an interest calculation that they're not accounting for, because there's principal there that they should be accruing on that hasn't been deducted because it's been 10 days late. So there's all these kinds of issues in there. And so we just can't trust the payments that are coming in. So we have to get concurrence from the seller by signing an affidavit saying this is true and accurate, and then the borrower with an estoppel phone call or estoppel letter saying, like, you're agreeing that this loan is at this balance value, right?
Right. So yeah, we've even seen one, I know you'll know what I'm talking about, that they started the contract by saying that the taxes and insurance were included, and they concluded the contract by saying that they were excluded.
Yeah.
So very, very interesting. And Chris commented here, I'm sorry, I hit the button inadvertently earlier, but Chris says, "Nice deal."
Thanks, Chris. Yeah. We want a happy investor, so we want to take care of them and make them have a good experience. We don't want them to not be in this business because of something that just happens. So the right thing to do is take care of them and put them in a different asset that is what they want. So
right.
Sometimes, Richard, these things aren't either insured or they're not insured properly, meaning the note owner or the deeded owner, not the borrower, is typically getting like a renter's policy.
Mm-hmm.
And that's not what we want to see. We want to see a homeowner's insurance policy, an HOI. And so those are very common things that we see that are an issue. They're not hard to fix. They're just an issue, right? Just common issues. The escrow typically is not established like we talked about. Sometimes it is, or sometimes they're putting it in the same bank account. And we have to be very careful, because we want them to sign this affidavit at the end of this closing saying, look, you, to the best of your knowledge, true and accuracy, this is the number that you're transferring over. So there's a lot of documents. They're signing correction affidavits. They're signing pay history affidavits. They're signing purchase sale agreements. They're signing deed transfers, allonges, assignment transfers. Like it's a big set of paperwork. And there's more than likely, Richard, an addendum that they're going to end up signing as well, which can be a lot more paperwork to sign and stuff.
Right. So more often than not, I see a lot of these moms and pops who just have the payments going into their standard checking account.
Yeah.
So I ask them for a payment history, and what I get is printouts with a whole lot of black lines through it, so I can't see what else they're buying. They just indicate the payments.
Yeah, they don't know what they don't know because they're not a professional. But we know who we deal with. We know who we're dealing with when we get into these loans. But we're just showing you guys the common problems we have. And now let's talk about the common qualities they have. We notice a lot of them, Richard, they have long pay histories. They got 3, 4, 5, 6, 7, 8 years of pay history, which is great to see.
Right.
Because the borrowers typically aren't underwritten like we like to. But if they have a long pay history and they're on time, Richard, we can work with that. We can definitely work with that.
Right.
The seller is usually motivated. Like they contacted us for a reason. They responded to our marketing message or our campaign or our direct mail. They responded to us and they're motivated because they want to exit out of this and do something else, which is great for us. So that those are all good things for us. The ratios, Richard, of the current unpaid balance versus the as-is value, they're very good ratios. We're finding a lot of good margins, meaning because of property appreciation and real estate being so resilient, it's really helping the situation to where things don't look that meek. So
I see a lot of what we're looking at is 40% loan to value or less.
Yeah, we're looking at a lot of good situations. So especially because these properties were seller financed like in 2014 or 15 or 16, when real estate was a little bit cheaper.
Right.
So we see a lot of good things there. All right. So simple fixes. This is what we do 9 times out of 10 if we're able to get everyone to agree to it. We just convert this thing to a note and mortgage. Just make it simple. Cancel that land contract. Don't deal with an addendum. Don't deal with getting the borrower and the lender to sign to fix the paperwork. Just get a brand new note and mortgage and just start over. You don't have to change any of the terms. You can keep everything the same unpaid balance, interest rate, the length of the note, what they pay. You just got to clean up that language and make sure it's clear and concise. You got to talk with the borrowers too. You need to get them involved. You need to make them understand that this is all good for you. And we'll get into that in a minute. But next thing you got to do is get them on the page, have a phone call with them. I don't let the seller talk with them too much. I let them introduce me to them. So they have that, they know the note holder currently. Then the note holder introduces me to the borrower, and then I continue the conversation and I talk with them. And I typically have pretty good success because they like what we're trying to do and they're definitely on board with it.
Right.
Richard, the seller and the borrower, they're going to pay most, if not all, the closing costs as well. So I'm really not out of pocket. We're selling this thing as this note's a problem, right? But there's an answer. There's a cure for this disease. We can fix that. It's just
right.
And
a lot of instances, it's just that we're more professional. You say that in a nice way, but we're more professional at doing this, and we can work that out. Before you move on, Chris has got a question here.
Okay.
Do you get to see the contract agreement before you bid, before your bid offer?
We definitely try to see that contract before we bid on it just for accuracy, but sometimes we don't because the sellers get a little bit skittish, which is fine. So all we do is we say, look, based on what you're telling us with the verbal information you gave us over the phone or whatever, is we repeat exactly what they say on paper and say, based on this information, this is what I can pay for it from what I know. But it's always subject to our due diligence. So it's subject to change. And that's what we would do. So I would say probably, I don't know, Richard, 75% of the time, we're going to get that contract in our hand. And so we can go through it and look at some more things and be more accurate with our bid. But a few times we don't. And we just, we bid it the best we can.
Yeah. And I mean, I must admit, I have been surprised in this whole process with this, because a lot of times we get some fairly sophisticated sellers and they don't even know how their loan works. I'm looking at one right now that we haven't talked about that much. And the way he made it sound is it's interest only for a year. So you have level payments for a year, and then it has an extra large payment at the end of the year. So let's say the payments are $1,000 a month. And then in December, the payment is $3,000 a month. Okay. And rinse and repeat. Well, when you look at the loan docs, it's actually amortizing and it's got that large payment. So it's completely different than he described, which makes bidding these quite difficult. So it is important to get the contract if you can.
So that would be where we would discover that during the discovery of due diligence. We'd say, hey, look, this didn't come to light. This does change the dynamic of it, because if their principal balance is lowering, or if it's not amortized like we assumed in the beginning, then we're going to fade our bid.
Right.
So that's just how we disclose that. So thanks, Chris, for asking that question. Another important factor of simple fixes for these things is that, oh my God, Richard, like this solves the CFPB and the Dodd-Frank issue right here, because we're not the originators now.
Right.
The seller is the originator, not us.
Right.
Because we're going to have them be the lender on that note and mortgage. And then we're going to buy that note and mortgage via an assignment and a launch.
Right. Which is important for everybody in the audience to realize that in general, that's the case. If you're buying a note is secured by real property, but the note itself is personal property. So only personal property laws apply to that. Now, some states have laws and regulations that say if you own more than 3 notes in a state, then you have to register with them, and et cetera, et cetera. But it still, as Justin says, gets us totally out of the origination category.
Yeah, we don't need to underwrite the borrower because we have that long pay history. Like they've shown through either a small down payment and long pay history, or a large down payment and a short pay history, that they're motivated to make those payments and to be a great borrower. So as long as the borrower and the pay history are strong and the collateral is good, that checks off the things on the box that are most important to us, and we can deal with the rest of it through different techniques. And this is one of the ones that we use more commonly now, and it just fixes all the problems just in one fell swoop.
Right.
All right. So why do the borrowers like this? They get a title insured full warranty deed. So they are now the deeded owner to the property, instead of just the land contract borrower having equitable title. They got full title and full rights, right?
Right. Right, which gives them all the benefits of home ownership.
Which include some tax benefits too, Richard.
That's
so
right.
Property taxes are going to be lowered significantly if they don't have the homestead exemption already, because some of these land contract holders, they're not recording the land contract, and so the borrower has no leg to stand on to get a homestead exemption or a mortgage exemption.
Right. And also, if they want to try and refinance, a number of my borrowers have said, gee, I want to pay you off, but I can't prove that I own the home. And I said, well, you don't.
Yeah. There's a lot of good reasons.
It's very difficult for them to get out of that box.
That's a great point. There's a lot of reasons why you'd want to be the deeded owner, because for utilities and stuff and other things, that if you're getting other loans or doing other things, it's great to have that note and mortgage instead of being the land contract holder. So there's a lot of good reasons. It's more secure, like we talked about, and they can leverage, as we just mentioned before. They can go out and refinance. They can get a HELOC on it. They probably have a gap of equity in there that they can use and leverage in some way, shape, or form. It's just going to be a lot easier for them to go through the process. The third-party verifiable pay history is really important. Like Richard said, because they want to refinance in the future, it's going to be very easy for them to be able to go to a new bank and be like, look, here's a verifiable pay history from a loan servicer. These people have been paying. It's helping their credit. It's all good, positive things. So that's why the borrowers like it.
Right. If they ever wanted to try and get a home equity line or anything like that, they would have to be the owner to do that.
Yep. So why note holders like this? Well, we like this. Richard and I like this because we're not on the deed. We don't want to be on the deed because you're going to get all these annoying county letters that come in. You get tax assessments. You get, any sort of code violations if the borrower is not taking care of their property and the grass gets too high. Like all those things come to us, and it's just annoying. We have to forward them on or deal with them ourselves because we're looked at as the deeded owner when it's a land contract. And it's just annoying, and we don't like it.
Right. It's annoying and it's a hassle, and inevitably, if we're the owner and they're not paying the taxes, we have to pay the taxes.
Yep.
And there's really, we have to then go back and get some sort of a arrearage agreement or somehow tack that on, somehow lien the property for those to get paid.
Right. So the note's more valuable to us as a note in mortgage or a note in deed of trust, because this thing is going to give us more value in the secondary market, which is what Richard and I do often. Is when we get these notes, we're going to resell them more than likely. And so this makes it more valuable. I can sell it at a higher price because it's higher quality paper, if you will.
Right.
The sale is very easily conveyed via an assignment of mortgage and an allonge. The assignment of mortgage is what's recorded with the county. The allonge is not. It's just an endorsement of the promissory note. But that's really quick and easy, and you don't have to deal with a deed. You don't have to go through a title company. You don't have to do. It's a very quick, easy process, and the borrower is not involved at all. The deed doesn't change hands, so you don't have to go through paying transfer taxes, because I know in Michigan in other states there is a deed transfer tax when you are changing the deed changes hands, and that could be a couple $100. And for example, in Michigan, a couple of counties that we've done quick claim deeds for and stuff from no owner, it's a couple $100 just for recording. So that saves you there.
Right.
So I got an example of one that I did recently. I think I did this, I want to say a few months ago, Richard. And so this came off of some of our seller financing advertisement that we do. I found a motivated seller that had a land contract in Huntington, Indiana, Richard, which is up north, kind of in the middle of the state, kind of before South Bend.
Okay. So
the land contract was written at a 1% rate. I know they're very generous.
Very.
It's $500 a month payment. And it had about almost $42,000 in unpaid balance, and it had about 7 years left on it. So I looked at this, and I'm talking to this gentleman, and I'm saying, okay, here's the situation. The 1% note rate is not the current market rate for seller finance paper. It's more in lines of probably, Richard, I don't know if you'd agree or not, maybe 8 to 9%.
I would.
And that's really what the going rate is. Found out that this guy is self-servicing this loan. That's a ding against him as well. The insurance is not properly insured. That's a ding against him as well. He's not carrying an escrow account. That's a ding against him as well. And so all these things are dings against him. And so the land contract language was a little loosey-goosey, as you can imagine. And so there were some contradictory statements in it. And I said, hey, look, we're either going to have to go through an addendum, and we're going to have to line item 4 or 5 of these things here. I said, or if you're in good standing with your borrower and you guys have a good relationship, let's just talk to the borrower and let's say, hey, let's just convert this to a note and mortgage. We're going to put you on the deed, all the examples, the positives that we just talked about. And I said, that's what we'll end up doing. I said, and I'll buy it from you the same day through an assignment. And he's like, yeah, I'm on board. That's good with me. And then I made him aware about the closing costs and how much it was going to cost him. And we just deduct that from the price. We talked with the borrower. I had the seller talk with the borrower this time because he was able to convey exactly what was going on. And so he went to the borrower. The borrower's on board. I got a lot of updated information from the borrower from that conversation that he had with him, as far as updated information about, kind of where they work and what they can afford, monthly and weekly and stuff. And so we had a good talk with them. So we get to the title company and we get ready to create the note and mortgage. So I go ahead and have the title company create it. And I just use the same terms. I use the 1% interest rate, the $500 payment, and then the unpaid balance that they owe. Exactly the same. I did this because I have no reason to change anything. It doesn't matter if this is a 0% rate or a 20% rate. I can adjust my pricing at what I buy this loan for based on that information, so that the return that I want to get and the risk that I have in the deal is going to be covered no matter what.
So
So
he was willing to take that much of a discount, because that's a pretty significant discount.
the seller was motivated enough to want to do that. They realized they were in a situation and they
Because he's
needed the money.
probably looking at a 50% discount on this off the UPB.
Not quite 50%. No.
Okay.
I think I can show the numbers here in the next slide.
All right.
So anyway, for 7 years. So
Mhm.
we get this loan and we close on it. We do the note and mortgage. I fund the deal. The seller pays for the closing costs, and the borrower paid for some of it too. I think it was about, let's say, $1,500, $2,000, I think, for the closing on this one, with the insurance policies and lenders policies. And so we get that closed. We do an assignment of mortgage. So I buy it within a launch and assignment of mortgage. And I also was able to get the borrower to pay for the servicing fees.
Fantastic. How did you do that?
So I just explained to the borrower, I said, here's your escrow account monthly, your breakdown. Here is what your P&I is, and here is what the loan servicing fee is. And they understood. And so they were willing to pay that monthly. And so that's how that got kind of pushed in there.
Cool.
So our servicing fee for this particular loan is $18.50 a month. It's with Allied Servicing. And so it doesn't seem like a lot of money, but it's a net now. So I have a $500 net payment coming to me with no other fees coming out of it. So it's a true $500 payment. So it makes my yield, if you will, more true and accurate as to what I'm getting monthly. I happened to season this loan for 1 month. I got the borrower to be on an ACH payment. So it's just like clockwork. Once a month, the money's getting debited from their account. And so it's great. I have an investor that's already lined up, and they have about $33,000. And I said, hey, look, I can sell you this loan for $33,000. It's got like a $41,000 balance on it. And they basically are going to get a 7.5% yield on it. And they got a pretty sweet little discount. They got what, $8,200 some dollars, Richard, built into that as discount. The property's probably worth, I'm guessing, about 50 to 60,000 as is right now. The borrower, they disclosed to us that they're actually repairing the house. They fixed the porch. I know you can't see it from this picture, but the porch is very well repaired. And they're doing some other things, and they're updating the house on the inside. And I think the roof is newer as well. And some other things about it that they updated. So those are all good signs. So they're making this property a lot more valuable.
So Justin, one thing that's good to point out here too is that part of the reason you were able to make this deal work is because you had room in the unpaid balance. So you paid 28 for it. You could have, if they would have accepted a lower yield, you could have actually run up the sales price probably up to like $40,000, just as long as you stay under the UPB. Well, that's good news on this instance, but a lot of notes you have to look at, because you can get trapped by that. And if your unpaid balance is too low, you can't get the yield you need. You shouldn't proceed with the deal.
Right. Yeah. So you got to protect the investor buying it as well, and make sure they have lowered their risk. So yeah, with a 1%, what we call coupon rate, a lot of people get turned off by that immediately, and they think that they're not going to make any money. But it's all about what you buy it for. So I got negotiated this down to 28,000 pretty quickly. I knew that I wasn't going to plan on keeping this in my portfolio very long, so it was a pretty quick way to make some money. So if you look at the flip price, I kind of flipped it pretty quickly within a month for about $5,000. If you count my marketing costs to get this loan, my time on the phone and email and texting with this stuff, we'll just call it $1,000 of my time and marketing money. So I probably end up making $4,000 on it, which is pretty good I'm pretty good with that.
Better than minimum wage.
Better than minimum wage. That's right. So that's a good, but I had to do some work to it, right? I had a dented piece of product that I had to fix. I had to repair. I had to make it more turnkey. So this investor is getting a solid yield for 7 years. For 7 years, they're going to be making $500 a month, and they pay $33,000 for it. And they're getting a note and mortgage, right? They've
Right.
got a full warranty deed already done on it. They got a lender's policy. They're perfected the first lien on it, and it's boarded with a servicer, and the borrower is paying via ACH.
Right. So I think it's important to say that the repair you had to do was not physical repair.
Yeah.
It was you had to use your intelligence to do this and repair it financially. And
Yep.
so it was all on paper. And that's a big factor in
Yep.
working with notes.
Yeah, so not a lot of people would see this opportunity and know how to fix it the right way and be able to resell it. So this is one of the advantages that Richard and I have, is that we know how to repair some of these opportunities, make them work. But what were the key factors, Richard? We had a long pay history, and we
Right.
had on-time payments, and that collateral was worth a lot more than what the UPB is. So those are the three things that made this deal very easy to fix all the other bad things with it and make them really good. So this is a very solid note, very solid deal. With a great borrower. So this investor will be really happy with this note. So speaking of that, Richard, we want to let our listener know that send us your deals. If you're finding seller finance paper out there and you want to flip it to somebody, if you're looking for somebody to buy it, send it our way. Get your smartphone out, pull out your camera, hover it over this QR code. It's going to take you to a special link. It's going to be our forms page. Save that in your URL, whatever browser you're using, and send us your deals. We can underwrite them pretty quickly within 48 hours, typically a little bit less. And we take land contracts, contract for deeds, note and mortgages, note and deed of trust, lease options. We buy all first liens. It could be performing or non-performing. We'll look at those as well. But yeah, by all means, we're looking to deploy some capital, and we want to see what you have available out there. They could be your notes that you have in your inventory, or they can be just opportunities that run across from you. So if you can't take down the loan yourself, that's when it's great to partner with another note investor like Richard and myself. So we can definitely help you take down those opportunities, and you can make a good little fee income that way as well. And we can do portfolios as well. We don't have to do just one note at a time.
That's right. We are. It seems like the market ebbs and flows, and at times you have mortgages or notes without no money, and other times you have money and no notes. And right now we have money to deploy. So
that's right.
Send them your way. Send them our way.
Yeah, we can spot some things and help with your education along the way as well. So that's we're getting close to our Q&A part of this. So if you have any questions or comments about anything that we presented today or anything about notes in general, please blow up that comments queue. If you're on YouTube right now, that'd be great. We're happy to answer your questions here. Our little last slide here before we step into the Q&A is going to be just to close out the main part of our presentation. Next month, Wednesday, December 8th from 6 to 8 p.m. Eastern time, we're going to have our next and our final broadcast for 2021. Then we'll be fresh in January for 2022. I'm Justin Bogard, and there's my email. You see Richard Thornton's email, richard@amnotecap.com. You can follow us on social media at BrightPath Notes for Facebook, Twitter, and Instagram. You can check either one, Richard or myself, on LinkedIn. You can find us on LinkedIn as well. And don't forget to join our Facebook group as well. We have a couple hundred members right now. We're trying to grow that even more. We're trying to put more content in there. So Richard and I are going to do a better effort to keep things fresh and keep you guys in the know. We have a Facebook group. It's called Be the Bank Real Estate Note Investing. If you see that little picture behind the yellow message that I have on the screen here, that's the one, that's the right group. So Be the Bank Real Estate Note Investing, and it's a private group. So come on in. It's a public group, but you have to be accepted to be in. So we will vet you. We have several questions we have to ask you, and so we'd love to have you part of the group. These broadcasts are streamed typically live to those channels. I messed up today, Richard, and I didn't click on Facebook to stream it live. So it's only streaming live on YouTube right now, but I'll put the feed on the Facebook groups as well, and our Facebook page as well. So my apologies about that. It's the first time I've done that. So I realized after we went live, Richard, that I didn't get Facebook hooked up to it. So.
We may have to redo our contract then.
That's right.
I'll have to talk to you that after the broadcast.
Okay. All right. All right, stay tuned, everyone. We're going to head over to our Q&A. Fill up that comment box there and ask any questions that you can. And Richard and I would be happy to ask them. So see you in a few. All right, buddy. Welcome to the after party. And got through another good presentation today. And shout out to our friend Chris, who's been giving us couple of comments here. We appreciate that. It sounds like Chris was mentioning they didn't know this option. I think they were talking about when we were converting stuff to a note mortgage at the same time we're trying to buy it. So yeah, right. Chris, this is a pretty cool little technique to where it takes a little bit of time, a little bit of effort, and it does cost the borrower and the seller money. But if you can sell it to them with all the good points that I was pointing out from the borrower's perspective and the note seller's perspective, this is a great way to turn kind of kind of note into a very superior note.
Yeah, it's a win-win for everybody. I mean, and it's just getting the borrower to realize it. I have to admit that I'm somewhat surprised with my borrower's logic. Sometimes I've got one guy who pays 20 days late every time, and I've called him up and said to him, "Do you realize if you just paid 5 days earlier, you wouldn't have to pay all the late fees?" And he says, I know. I mean, you got to think that this guy could escrow enough money to get 1 month ahead so he wouldn't have to do this, but he doesn't mind paying it. So anyway.
Yeah, those late fees are a little bonus gem there, because some servicers will split the late fees 50-50 with you. So if it's a $30 late fee, it could be an extra $15 a month that you get just because the borrower pays late. I mean, they're paying more interest in the long run as well, because they're accruing more interest on the principal that they're not deducting on the same day every month. So there's actually a lot of positive things when the borrowers are habitually late. It could be more money in your pocket.
Yeah, a lot of people are afraid of that, but until they really get 90 days late, I'm kind of like, okay, that's fine. I mean, it's I'm not going to run out and spend the money tomorrow anyway. So
that's true. Chris was asking about our Facebook group. If it's just for newbies, just learning, or more seasoned note investors, it's for everybody. Right. Richard and I try to tailor conversations for the very new person that's very green in notes, and to a very seasoned person as well. So we kind of touch on different advanced techniques. So if things go too fast or too slow, it's because we're trying to accommodate for our entire listening or viewing audience. But yeah, so the Facebook group is not necessarily specifically geared toward newbies, but we have a lot of newbies that join our group as well. So you can ask questions when you're not on the broadcast, and we can have content that we can bring up for the next broadcast as well when we can stimulate good conversations. So.
Yeah, and you can always email us. I mean, if you've got one specific deal that you want to ask about, we're glad to give you some input on it, whether you're going to do the deal with us or not. I mean, yeah, Justin and I both have leaned on others at times to help us come up on the learning curve here. So we're glad to give back.
Definitely, yeah. So there are some. I think it's more fun to be buying seller finance paper from mom and pops than it is buying from the big banks and the hedge funds and other institutions that are more professional. It's just the more professional ones, there's an ease of the transaction, right? It's very clean. It's very simple. Everything's disclosed, but you end up paying a little bit more, right, Richard? Because things are handed to you on a silver platter. Mm-hmm. You have opportunities like you saw before in my example in the Huntington, Indiana, where you can buy things for a pretty significant discount based on your selling techniques, and then looking to see the opportunities, hearing the motivations of the note seller and trying to solve their problem. And so we've been able to see some pretty nice deals that we've been able to turn into great deals because we're able to solve a note seller's problem. And so I think it's just an untapped arena. It does take a lot more effort, a lot more work. There's a lot more marketing that Richard and I have to do behind the scenes, which is why I was saying, just call it $1,000 that I spent, in time, energy, and marketing just to get that deal done. But, if I get a couple of those a month like that, that makes for a pretty sweet little side income. And in the interim as well, we're able to keep some of those loans in our portfolio too. So we don't always flip them to an investor. We do keep some of them in our portfolio for a couple of years at a time. So.
Right. I think though some people would just say you've got a rather odd sense of fun.
Yeah, it does take a good system and a good process to do it, as Richard can attest to. It can be challenging, but if you have a good process and system built for it, it can be very rewarding. And there's not a lot of competition in this as well. There's not a lot of competition for note investing anyways, but if you narrow it down to even a smaller sector, buying mom and pop paper from seller financiers is an even smaller sector with less competition.
Yeah, I think it's it can be rewarding in just a whole lot of ways, as you've just mentioned, especially when it's a win-win, and you can both make a nickel at it and give somebody a better situation, whether they truly realize how much of a better situation you're giving them or not. You're doing it, so that's great.
Yeah, it's when you're reviewing these land contracts and these documents, you begin to understand what an attorney goes through to write these documents. And so it's funny, you see some language after a while, it's pretty common. Then you feel like, well, maybe I have the confidence to write one of these myself and just have an attorney, put their stamp of approval on it.
Right.
But yeah, it's when I have an attorney draft some of the documents for us, they kind of give it to me and I kind of scratch it down, be like, no, we need to put this in here. They're like, oh, you can do that. I'm like, yeah, you can do that, because they haven't seen it all. We see it all because we see a lot more of this paper than they do. I mean, They know how to write it up. You just got to be able to explain to the attorney, what you want done as the lender in the document.
Yeah, and I have to say, I had a commercial lending background before I really got into this aspect of notes. And a lot of the concepts that we talk about now that you and I take for granted, I had never heard of before I got into this. I mean, this is so unheard of in the conventional field that this is a lot of fun, as you would say.
Yeah.
See, Chris says, look for my request.
Oh, cool. Chris, we'll definitely do that. We'll do that and get you in the group. Feel free to ask questions, and other people in the group. There's a couple other moderators. Larry, Gill, and Mariska Pilch are also moderators in our group as well, and they help answer questions too if Richard and I don't get to them in a timely manner. So.
Right. Did you want to say anything more about Expo? Anything you got from there, or?
I think I was just so happy to see faces that weren't two-dimensional anymore. It was nice to see real people and be able to fist bump or elbow or just be near somebody and just see their mannerisms, and just, it's so much better, obviously, to be in person with some of this stuff. I know things had to be on Zoom and stuff, and I agree with the decisions, but it was really nice just to be in a room with a bunch of other like-minded investors and a lot of, the people and our friends that we know in the note community. And it's just a lot of fun just to be back. So I was enjoying just being around people and being around the Note Expo event, because we had taken a year off from it. And I did learn a lot too. Like at the beginning, we kind of talked about, there's a non-performing wave coming through that not a lot of people are talking about, was all the non-performing loans that were before COVID that had to go through COVID, and now they're sitting here ready to start going through foreclosure. And so that was an interesting takeaway. They talked a lot about the Seller Finance Coalition, to where they're trying to get, excuse me if I say this wrong, it's the HR 5013 bill, trying to get your local rep and senator and representative, House representative, to co-sponsor this bill so that we can put a squash to this rule of doing 3 seller finance transactions a year. We're basically trying to raise it to 24. And the Seller Finance Coalition has done an amazing job. They actually brought the original, I don't know what you call it, the original sponsor of the bill was actually there. It was a senator from the state of Texas, and he was Senator Gonzalez,
A
Vicente
Democrat,
Gonzalez.
no less.
What's that?
He was a Democrat. I mean, that blew me away. I had no idea that, because that's a pretty conservative crowd down there. But they would actually have a Democrat sponsoring it for him.
Yeah, he mentioned he isn't far left. He's a moderate Dem, so he's more closer to the centrist line.
Yeah.
But yeah, that was interesting as well. So that was pretty cool to get some bipartisanship on that bill pretty easily. So, anyways, Richard, I'm making an effort to actually go to our local reps and talk to them face to face to get them to try to co-sponsor the bill. So that's my plan the next couple of months, is to get that going.
Good for you. Yeah, I think. I mean, I was pleasantly surprised once again on just how much you can get done in a meeting like that. I mean, I had at least a dozen of conversations where I really learned something. I mean, yes, you learn something from the speakers, but I got a lot of business done on just from talking to people like us. Gee, do you have a deal here, a deal there, or whatever, a new idea? There's a lot of value in rubbing elbows.
Exactly. Yeah, it was a lot of fun. So that's, I don't know if I had the biggest takeaway from it, but I definitely still on kind of a high from the experience of it. I hope that we get to do another event soon. I believe the next time we're going to have an event kind of like that, I think, Richard, is after close to the end of the first quarter.
Right. And there are other events too. There's Noteworthy and some other ones. They tend to be, I guess it's fair to say, more for newbies and a little more commercial. You're being sold more things at those than Note Expo. That's one of the things I like about Expo. It's more education and less selling. They have some vendors there, but you don't have vendors up being the presenters like you do at some of the other ones. And I appreciate that.
That's a great point, Richard. And I didn't attest to that, but I want to back you up on that and say that's totally true. No, everyone up there is either telling their story or showing you how to do something new and unique that they do that they can add to your business. And they come in and they do this, off of they all have busy schedules, right? They all run companies, and people that come in and speak, or the keynote speakers, like they're all doing this to help us out. And that's what I appreciate the most. And that's what I like about Note Expo too. And I should have started off by saying that, but you're right, Richard. No one is up there pitching.
Right.
They're not pitching anything. They're just explaining stuff that's going on. So it's like you're glued to your seat from the minute the conference starts till the last part of the day, because every speaker up there, every panel they have has some sort of value that you just need to learn from or need to know. And it's really cool. And they have a lot of newer students through Note School that get up there and talk about their case studies and how they bought a loan and what they went through with the loan, the trials and tribulations with it, and how they came out in the end, if it came out great, if it came out okay, or if they learned some things from it. Like, it's really cool to see the real facts and the real data from people in the note industry. And I think that's why I like it the most, because there's nothing fake about it or nothing, aloof about it. It's all real and it's raw. And some deals that you hear about and they talk about, it's just like, oh, are you kidding me? That is just incredible. I mean, the profits on some deals are just like, wow, that's just amazing. I had no idea there's a potential like that. And they're not all like that, but it just wows you. And you're just like, oh, that's so cool that you're able to do that. And they usually end in a happy story where the borrower gets helped out in some way that otherwise they wouldn't have been helped out at a big bank. So.
Yeah. And it's inspiring. I mean, it makes you realize that there's a higher goal that you can reach. And especially because one can get frustrated in this business. They can say, well, gee, I can't find this or do this. But if you go to something like that, it re-energizes you. So it's great.
Absolutely. Richard, we're out of questions for today. We appreciate everyone that chimed in and said hi and asked questions. And thanks, Chris, for joining our Facebook group. We'll get you in here in just a little bit. And so I'm Justin Bogar with Bright Path Notes, and we'll see you in December.
Yes, we will.
That's my buddy, Richard Thornton, everybody.
All right.
All right. See you guys.
Okay. Bye.